Kohlberg Kravis Roberts & Co. (KKR) is a major investment and merchant banking firm in the United States. According to Forbes, back in the early 2000s, its American and European businesses had combined sales of more than $20 billion alone. KKR was a pioneer in leveraged buyouts, LBOs, in the 1980s, when it carried out several deal-making firsts. In 1979, the firm completed the first large public-to-private transaction. So, how do Kohlberg Kravis Roberts make so much money? In 1989, KKR paid $30.6 billion for RJR Nabisco Inc., which at the time was the biggest LBO ever. Since its inception in 1990, KKR has completed over 100 deals with a total funding of more than $100 billion. KKR has continued to break new ground in the 1990s, becoming one of the first American companies to finance a buyout in Europe in 1997. It had 6 European firms on its books by 2003. Let's look back to see where the real money was made. In 1965, Jerome Kohlberg Jr. was in charge of the corporate finance department at Bear Stearns & Co. when he came up with what would later be known as the leveraged buyout. Kohlberg, the smart cookie, felt that a business should be better controlled if it were managed by a small group of passionate investors, which often included the top corporate executives rather than thousands of shareholders who had little knowledge or time to ensure it was being run efficiently. KKR would always keep this principle in mind as it operated throughout its history. To raise the cash, investors would borrow heavily, usually pledging company assets as collateral, in some cases even more. They would be able to profit by selling the firm to new owners or putting shares on the market after a period of time. Between 1969 and 1975, they completed 14 buyouts, with a mixed success in a period of recession and stock price drops. Kohlberg Kravis & Roberts was formed in 1976, when Kohlberg convinced Kravis & Roberts to join him in the business partnership. KKR established an equity fund that it used to acquire firms as a general partner. Many major lenders decided to invest in the pool. They were guaranteed fixed returns, and in some cases, they received warrants or common stock for free or at a very low price. Banks often like to invest in preferred stock because it offers an 85% tax exemption on dividends. To make interest payments on the large debt incurred in LBOs, a potential target had to be able to produce a lot of cash flow. The most attractive prospects were businesses like supermarket operators, provided they had little prior debt and a market niche that protected them from severe competitive pressures. This excluded high-tech companies with heavy research and development expenditures. In 1977, KKR acquired 3 firms, but finding investors proved difficult and no negotiations were done the following year. In 1979, KKR acquired Hudale Industries for $355 million, which was by far the largest LBO deal at the time and KKR's first buyout of a significant publicly listed firm. Prior to that, no LBO had exceeded $100 million. With its own cash investment of $12 million, KKR obtained 37%. The majority of investors, including large banks, began to take notice. By the fall of 1980, the firm had spent nearly $800 million on 7 firms with combined annual revenues of around $1.3 billion. In 1981, Roberts hired a conservative investor, the Public Employees Pension Fund of Oregon, to put up $178 million for the leveraged buyout of Fred Meyer Inc., one of KKR's 7 targets after this success. Many other pension fund investors seeking a higher yield than what they could get from bonds were prepared to join. KKR equity pools began partnering with 11 state pension funds in 1986. In 1987, KKR launched a $5.6 billion fund, which was its largest to date. The 11 supplied 53% of the money for this fund. In order to finance an LBO, KKR needed money from a few different sources. Pension funds and other limited partners provided equity, banks lent money, and subordinated lenders provided money at a higher fixed rate in exchange for taking on more risk. KKR shared the standard fee of around 1% to make this deal. The fee is usually invested in the stock of the company that was acquired. It also received yearly consultancy fees from the acquired firm. KKR partners sat on the boards of these firms and collected directors' fees. KKR was also paid a 1.5% management fee on money in an equity fund that had not yet been invested. The real payoff for the firm as a general partner was its 20% stake in the accrued capital gains of the acquired company. KKR charged a 1% fee when it sold a company for a loss. Everyone in the company, from the senior partners to the secretaries, had a part in the profits. In 1983, KKR claimed an average yearly return of 63% to its equity partners. That year, KKR's fourth equity fund amassed $1 billion in investor cash, allowing it to expand its roster of firms to 18 and acquire for a total of $3.5 billion. In 1985, KKR acquired Stora Communications for a record $2.5 billion. Partners of KKR gained an annual return of around 50% when Stora was purchased in 1988. In 1985, KKR completed its first hostile takeover, which it had previously done only when management agreed to do so. In 1986, the firm launched a new $2 billion investment fund. According to an article published 10 years later in Fortune, the purchase of Safeway Stores Inc. was KKR's most lucrative transaction ever. The company received $4.3 billion in financing, but put down only $130 million and earned more than $5 billion in realized and paper profits. By early 1997, the value of KKR's remaining one-third in the firm was $3.5 billion or more, reaching a peak of $7.4 billion by 2001. In 1987 to 89, Kohlberg drifted, then departed from KKR. After spending 1984 recuperating from a life-threatening illness, he returned to discover that his younger partners no longer needed or desired him. Kohlberg's refusal to approve any more acquisition deals earned him the nickname Dr. No at KKR. In 1987, Kohlberg resigned from KKR and established his own firm. Nevertheless, he remained a limited partner with KKR. In 1990, Kohlberg sued his partners, claiming that they had illegitimately reduced his participation in several buyout agreements. The case was resolved under confidential terms. KKR's dominance seemed unshakable at this period. The firm acquired 8 firms for $43.9 billion over the next 2 years, including more than $1 billion in purchases of Owens, Illinois, Duracell, and Stop & Shop. The 1990s. Following the completion of the RJR Nabisco transaction in February 1989, KKR did not make another leveraged buyout for 3 years. Not because it was losing its nerve, but owing to the junk bonds market collapse, a growing reluctance among lenders to finance such deals, and a reduced number of corporate raiders attempting to put firms on the block. KKR became less appealing to partners like the State Pension Fund because it was not able to generate lucrative LBOs. This prompted them to complain about their expenses. KKR's annualized return was 19.5% in 1989, far below its typical rate of return. Investors wanted to be compensated for the high risk they were taking and the need to keep their money tied up until there was a payoff. The payoff would come in the form of a company sale. Leveraged build-ups was another KKR approach. In 1989, the company bought a piece of Macmillan Inc., which it transformed to K3 Holdings Inc., a publishing and information resources conglomerate that had made 52 purchases by 1997. It was renamed Primedia Inc. after this. This venture was unusual because KKR took on most of the risk itself. KKR took 6 prior LBO acquisitions public in 1991. This resulted in a six-fold return to the investors within 5 years. In one swoop, KKR silenced their doubters and also received their additional fees. In 1992, KKR paid $1.2 billion for American Reinsurance Company, an LBO deal at $10 a share. KKR kept a 1/4 stake and offered the company to the public 4 months later at $31 per share. Also in 1992, it established a new fund worth $1.8 billion. As the stock market surged in the mid-1990s, KKR increased its earnings by selling some of its acquisitions. The sale of Duracell, which became a public company in 1991 and was sold to Gilletteco in 1996 for stock worth $7.9 billion, returning KKR $3.7 billion. In 1996, KKR raised $6 billion for the fund. The company agreed to cut its transaction fees and deduct losses from profits for the first time in order to meet this amount. The Oregon Pension Fund was among the subscribers, which despite its reservations agreed to $800 million after a sales pitch by Roberts. The year was Kravis and Roberts' most strong yet, with each reported to have taken in $3 million for KKR. Kravis's personal wealth was estimated at more than $1 billion. Do you want to know how much money came next? Let us know in the comments below.